So I like to do this webinar at the beginning of each tax season, just because I get so many screw ups throughout tax season of the client not gathering the data that they need. They don't know what data they need. And most importantly, they don't know how to communicate this with their CPA. So I do this video intent to basically educate and show business owners what they need to do to file their taxes the right way. So the first part that I want to do is basically go over the PDF that I share with you guys in the chat. And then from there, we're going to just answer any questions that may happen. And we'll take it from there, really. So the first thing that we're going to go over, let me share the screen. Is basically the tax prep checklist. What your CPA should be doing, they should be helping you gather or at least educating you on the documents that you need. So let's take a look at this. This is the PDF that I sent within the chat. No matter where you're at in the stage of your business, whether you just started or you've been making 5 million in whatever industry that you're in, these are the basic items that you're going to need for both business and personal. Check this out, guys. It's always your personal or business information, right? Your social security, full name, spouse name. It's always, they're going to basically collect this personal information. Granted, if your tax person has been filing or your CPA has been filing your taxes for 3 years plus, they probably already have this stuff. You just need to let them know if any information has changed, right? Meaning, is there an address change on the personal level? Did you have a baby or a dependent, maybe a grandparent that you're taking care of? Or in some case, as you know, us millennials are getting older, is there your parents you're taking care of and you're supporting basically half of their income? You need to let them know any of those changes, right? Most people, they don't let the tax or CPA preparer know these changes. So the CPA is making the assumption that they're just going to file the similar tax returns as if they did last year. Right. So make sure you let your CPA know that, hey, guys, I had some personal information that changed. I got married this year. I had a baby this year. You want to let your CPA know those changes. That leads me on to the dependents, right? Give your CPA the birth certificate, social security, tax ID. But one of the most important things that you should be giving your CPA is your daycare expenses. Those can be write-offs for you on a personal level. You want to take advantage of those credits, right? So you should know the EIN of the daycare, whether it's a business, or the social security if it's a daycare giver, whether they're individual or business. You need their EIN and their address too as well to collect. And you need the total amount of what you paid out to them. This can help you drastically with getting some deductions on the expense level. Very important, super important. And I'm going to speed through this because I don't really want to talk about this part. I want to speed through this part. It's the sources of income. Everyone knows the W-2. Everyone knows the W-2. Hey, when I'm filing taxes, when I'm working, I get a W-2. I send my W-2 over to TurboTax or maybe my CPA. All right, depending on where you're at. But mind you, for anything that says 1099, that's basically some type of income that you probably should be giving to your tax preparer or CPA. Right. So if you're unemployed, it's going to be a 1099-G. If you have rent payments, if you get rental income, there's going to be a 1099 miscellaneous that's going to collect that rental income. You need to give those things to your CPA. Most people don't. I had a story where I guess this is early in the years. A client had a real estate property. Well, half of his property was his personal home. The other half was rental income. Right. He rented it out to a tenant. He was collecting payments and he was not basically reporting this to the IRS. That is a huge no-no. That is us avoiding taxation. Right. We don't want to do that. We want to make sure we're filing in a compliance manner. Right. So those rental income that you're getting from you renting out your property to tenants, we need to collect that in the form of 1099s. So mainly, if it's something that says 1099s on there, that's something that you need to basically send to your CPA so they can account for your revenue. Now, I want to pause here and focus on the self-employed. We have a lot of people that are W-2, but they started some side business, or maybe they're a high network individual. They make a lot of money on the W-2 side, and someone recommended them that they start a side business so they can take advantage of business deductions. So most of the headaches that come there is they're not accounting for any of their expenses. They're not doing it on Excel, which I don't recommend, and they're not even trying to open up QuickBooks. So when you have self-employed income, whether you're a realtor, a plumber, you have a side business where you're a travel agent, you need to basically be doing these two things: tracking your income and recording all of your expense. Because mind you guys, we're paying taxes on the profit. That's revenue minus expenses equals profit. We're paying taxes on those profit. I don't want to overpay in taxes by not paying my expenses. So keep that in mind. Another thing that is, and I'm gonna bully my realtors because all my realtors have the same issue. They're a realtor probably making under 150. They don't think of themselves as a business. So they never come with their financial statements, and they never have a list of all their assets. They usually say, I don't have any assets. I let them know, what are you driving around to do your real estate job? What are you driving around? They said, I drive a Lexus, whatever, a BMW. I'm just throwing out a car. I said, okay, are you using it for business? Yep. Are you using, what percentage would you say you're using for personal or business? These are conversations I'm having with, my realtors in this case. I'm just using them as an example. They say I use about 70% of the time. I'm going to basically account for 70% of that as some type of business write-off, either using bonus depreciation or Section 179. Because mind you, most self-employed, when they're self-employed, they're probably just a 1099 contractor. They receive income as 1099 and they don't have any expenses. That opens the floodgates up for you basically overpaying in taxes, because you're not even thinking about accounting for your expenses, nor do you have any. Therefore, we have to basically come up with some expenses. I'll use this as an example. We have an ER doctor that he gets paid over, I think it was $500,000. He just moved over to 1099. This ER doctor basically was receiving his income as 1099s. When you're receiving your income as 1099, you have to pay taxes when you file, right? Or the quarterly taxes. I recommend doing quarterly estimates, but he has to pay taxes when he files his tax returns. So what we did, we took him, we made an LLC, created an S Corp for him, and now we're running payroll for himself, basically, right? But we had to legitimately turn him into a business. We had to switch the mindset about that, because he just thought that he was a W-2 person. We had to change the format of him conducting business. He has payroll. He's an S Corp entity. He has QuickBooks set up. We're calculating every expense associated with him providing ER doctor service for whatever agency or hospital that he's doing that for, right? So those are things that I want my self-employed people to do, right? And here's another. I'm gonna put focus on here, because our firm we do file taxes for business owners. That's primarily who we're filing taxes for. One thing that your guys do, you miss putting your 1099 income on your tax return. You miss doing that. So what happens is you file your taxes, you don't have that 1099 income that you're accounted for. And say if you're married, your wife puts the W-2, but you forgot to put your 1099. Think of that. You're like, it shouldn't go on there. You're wrong. Your 1099 self-employed income needs to go on your personal tax return as a Schedule C. So what happens when you don't report that? The IRS looks at your wage and income transcript and says, a realtor company paid, let's just use Joseph. A realtor company paid Joseph a 1099. But when we look at Joseph's tax return with him and his wife, I don't see a 1099 listed on that. So the IRS sends you out a letter. Say, hey, there's a discrepancy. I see that you got a refund on your taxes, but actually from our calculations, it looks like you're probably gonna have to owe, because you have this 1099 income that wasn't reported on your tax return. Now the wife's looking at you, and these are real stories. I can't use names. Now the wife's looking at you like, you got to get organized, sweetheart. You got, she's kind of mad because now there's a $10,000 IRS tax bill on their dinner table, and they think that they need to pay that. But in reality, they probably just need to amend their taxes, put your 1099 income on that with your business expense, and that bill won't be $10,000. You may owe something. I'm just using numbers, but you may owe something, but it's not going to be that $10,000. So many IRS tax resolution cases come to my table because of that situation. Somebody forgot to put their 1099 income because they're not treating their side hustle or their main hustle or their business just in general as a legit business. That's a huge red flag. That's a no-no. That's going to cause headaches later on, because the IRS, guys, they're a collection agency. They're looking to collect on taxes paid, right? They're looking to collect on taxes owed, excuse me. They're looking to collect on taxes. So what are they going to do? They're going to send that one letter saying, hey, your real estate agency, they sent you a 1099, but we don't see this 1099 reported on your tax return. What happened, Joseph? And then they're going to send that letter out. You're probably not going to know because the IRS uses weird language to kind of make it confusing for you. And you're actually going to think you owe that $10,000. When this case is, you just need to refile your tax return correctly, doing your taxes the right way. That's why I had to do this webinar, because I've seen so many incidents that happened this year. In 2024. So make sure that we're filing it correctly. And here's the thing. You giving your bank statements to your CPA isn't financial statements. It is not financial statements. Financial statement is basically a accumulation of all your business bank accounts related to that business, compiled and then recorded for each transaction into a different chart of accounts depending on what that record was, and then it forms a financial statement. You sending me bank statement shows one particular screenshot at one moment and not the full picture of the financial statements that I need. And some banks kind of give like a snapshot that isn't showing the full picture. That's showing basically chapter 1 out of a 12 chapter book that I need to know in order to file your taxes, right? You giving me this basically does not do anything for me at all. It only shows a screenshot. So make sure that you have your financials. You know that you have business assets, any assets or equipment, machinery that you're using to do your business, and make sure that we're accounting for all that. And then if you're on the smaller side and you do a home office, make sure you tell your CPA, hey, I want to factor in my home office. I'm a realtor or I'm a government contractor and I use my home office as my main office right now. That means I get to take your rent or your mortgage interest or your rent, depending on if you own or rent, and I get to take a percentage of that and basically add it as a business expense. I want to do that. That will help out the tax situation, right? So those are just some of the few of the things that we need for if you're self-employed. But guys, we can end the webinar right there. That's a huge, important thing to do. Because I've seen so many cases, I've seen so many IRS issues of someone sending in not sending in 1099s, the IRS saying, hey, I think you should send it over. And they're kind of confused on, I don't know what to do. So they just pay the $10,000, knowing that this is completely reversible. Or having to deal with a firm like ours where you have to pay us X amount to solve the issue. All right. So let's move on from that. Rental income. I've talked about this briefly, but more of the story, this is very similar to self-employed. If you have real estate property, for each property, I want to know the income associated with it and the expenses associated with you having that property. How much did the tenants pay you? And then what expenses that you have to do the upkeep of that property to get it running so your tenants are happy and they continue living there. I need that for each property. Some people put this in Excel sheets. Some people have fancy softwares. Some people have QuickBooks that calculate all this data. That's fine. All your CPA needs to know for each property, for each building, your income associated with that building and your expenses. Because we're going to have to report it on line A, B, C, and then do the same thing again if you have multiple properties. One thing that my clients kind of miss out are for just taxpayers in general. They don't know about the depreciation or they don't know about real estate activity participation rule. They don't know because I have some, I want to say people that's in real estate, that's all they do is real estate and they still have a W-2. You logging yourself as a real estate professional allows me to make real estate, which is a passive activity, into an active activity. Usually, most of the time, due to depreciation and other expenses, your real estate usually takes a loss on paper. I get to use that loss to offset some of your W-2 income because both are active. If we keep that real estate passive and not log that real estate participation rule, I can't offset your W-2 income. That saved some of my clients so much money in tax liability. So much money, because I get to take a loss on that. Therefore, they don't have to pay all that payroll taxes out of their W-2. And they're either getting a higher refund or they own less in taxes. That's really great. That's really great. So, keep that in mind when it comes to rental income. And mind you, one thing that you need to do, you have your Excel sheet and your income expenses for each property, but you got to make sure that you give your client, your CPA, the purchase agreement. I need to know the year that it went into service and how much you purchased for. The year that it went into service and how much you purchased it for. And the land value, that's kind of going to show that for me. Because I want to pull in depreciation. It's an extra expense that the IRS gives you that we get to put on your tax return that helps drive down that profit, which we're taxed on, on the tax return. So huge thing, I want to keep that in mind. Retirement income. So remember I said that 1099s? If you do any type of IRA or any type of investments, know that you're going to get a 1099 for that. Send that over to your CPA. They're going to punch that into their software. And that's, these are simple. The retirement income and savings and investments, it's classified as income. So, make sure that you send over these documents to us. All right. So I want to skip past some of these. And I want to talk about these type of deductions. So normally the IRS gives us standard deduction. As of 2024, when we filed taxes, it's $29,400, I believe. I just rounded up to $30,000 for married filed jointly. Half of that if you're single. So what I want to say is, usually the IRS gives us these standard deductions. But say if you're married filed jointly and you have these type of deductions that we're about to go over that total up more than $30,000, I want to use what we call these itemized deductions. Your home and vehicle ownership, there's certain mortgage interests on there that we can take advantage of. There's charitable donations, medical expenses, certain child care expenses and educational expenses that we can use to basically offset the standard deductions and use the itemized deduction. Therefore, I get to take a higher deduction to help reduce my tax liability, right? Your property tax, state and local tax, if those tally up to be more than whatever your standard deduction may be, depending on your filing status, I want to take advantage of the itemized deductions. So it's very important to look at. I wouldn't say most of the time, but on average, or high majority of the time, people are just taking the standard deductions. But if you don't, I have some clients that's donating over $30,000 to charity, right? They're huge givers. Therefore, I want to use the itemized deductions. The standard deduction is only going to take that $29,400. I want to take the itemized deductions on that, right? It's just because it's going to be more. So, I wanted to basically just clarify some of that tax preparation checklist, just to kind of help out and know that there's things out there that's going to help you reduce your tax liability.